What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. I'm going to have an interesting one for you this week. I want to talk about how new investors or experienced investors should think about seeking out advice when looking to grow their portfolio, grow their business, etc. And frankly speaking, I think this is applicable. I think the comments that I'll be making throughout this episode are going to be applicable to anybody who's looking to grow a real estate business or any business, right? And this is going to be a little bit more of a generalistic episode as it relates to what I'm sharing my thoughts on, but I'm going to relate it to real estate as best I can so we can make it pretty tactical here. But I think as I've continued to produce the podcast and speak at networking events and meet other investors who are looking to grow their business, I think it's really interesting as it relates to the type of advice that many investors give newer investors. And put in a different way as well, the types of people that new investors seek out from an advice standpoint and for guidance or commentary on what they should do and how they should, buy the next deal, grow their business, etc. And I think there's a lot of issues with it, which is why I'm recording this episode. I think that many investors, many new business owners, many entrepreneurs, whatever, they are typically going out there and looking for advice from the most successful or the most seasoned, however we want to define that, investor, business owners, etc. Right. And this, to paint that picture, it's the 25-year-old, 30-year-old real estate investor or business owner going out and speaking to the 60-year-old vet who's been in the business for 30 years, and who's seen it all and has been through multiple cycles and all of that. And they want that guy or gal's feedback, commentary, advice on what they should do next. And oftentimes, those people are not going to give you good advice. And when I say good advice, I don't mean that their advice is wrong or incorrect or that they aren't, that they can't provide helpful advice. It's just that oftentimes, when you get advice for somebody who's 10 steps farther ahead of you, it's not even remotely applicable to your current situation, and it's actually damaging, and it actually hurts your ability to continue growing your business or your portfolio. So what I want to do in this episode is talk about the different types of advice that people who are at different stages of their business growth or at different stages of their life, which I think is a little bit more relevant here, should be seeking out, right? And I'm going to, I'll probably incorporate this in the title in some capacity, but like the difference in advice that a 25, 40, and 55-year-old real estate investor should seek out and should get and will likely receive from folks who are in those different stages of their growth. So for example, let's pretend we are the 25-year-old real estate investor who is starting their career, right? The last person that this individual should go reach out to is the 55-year-old real estate investor who's been in it for 30 years and who's got a big portfolio. And then personally speaking, in their personal life, they have a family. They've got some kids who are, going to college or are in college. They're winding down what they're doing from a business standpoint. Their risk profile is entirely different, etc. When that 25-year-old asks that 55-year-old for advice, it's really hard for that 55-year-old to recontextualize their just their opinions on investing in business growth, etc., to provide actual value for the 25-year-old, right? And oftentimes they're going to say, well, you want to avoid risk. You want to buy in great areas. You want to, you don't want to work with partners because partners can make it harder for you to grow your business. And there's a lot of bad partners out there, so you should really avoid partnering with people. You don't want to buy deals that need a ton of renovations. Like all of this stuff that is just a different code for take less risk, be safer, don't color outside the lines, etc. All valuable advice. It's valuable advice for the 55-year-old to give that to the 40-year-old or somebody else who's in the same season of what, of life and business growth that they're in. In reality, if you're a 25-year-old investor and you're trying to go from your duplex to 25 units in a few years, none of that helps you do that. None of that is applicable. All of that actually steers you away from making the decisions that allow you to accomplish what you're trying to accomplish, assuming that's your goal, which oftentimes it is. I want to buy more deals. I want to grow faster. How do I do that? I want to grow a big portfolio, whatever. In reality, for the 25-year-old, who likely doesn't have a family, who likely, just doesn't have that much to lose, fundamentally speaking, financially, I'm saying, the advice needs to be different. It needs to be contextual to that situation. So, for example, when I'm asked, because I'm in this situation all the time, and I'm not that much older, right? I'm 31, but I started doing this when I was 22, and a lot of guys who are in their mid 20s are reaching out, going, "Hey, I want to grow a little faster. Like, how do I do that?" And I'm like, "You come to the right place, because I'm not that far removed from being the 25-year-old who was growing aggressively and making those decisions." And the decisions you make in order to accomplish the goals when you're younger are totally different than when you're older, right? Because you are in a different season of life. So, for example, that 25-year-old should be probably taking on lots of debt. Just let's speak plainly. Should probably be using bridge debt and hard money loans that carry a little bit more risk to get into maybe slightly hairier projects, but that offer far more upside potential. You probably have to be a little bit more open to partnerships. You might have to be a little bit more open to working, not working with vendors that are going to eat into your margin as an investor, right? You might have to self manage those first few while taking on some, more expensive debt because you can't afford to do let's put the 30% down and not take risk with debt, which is what the 55-year-old tells you, right? Never go above 70 LTV. That's too risky. Never go above 60, whatever they say. If you're 25, that doesn't help you, right? When you're 25, you have to make decisions that align with the season of life that you're in. You need to take on more risk, you have to take on more debt, you need to feel a little bit more uncomfortable with maybe the project you're getting into. You're probably going to sleep a little less at night because you're going to be stressed out because you got more on the line. But what I think people fundamentally have a hard time realizing or understanding is your season of life so significantly dictates the types of decisions that you should be making. When you are in your 20s, like there is no downside to losing money. Like that is something that I really wholeheartedly believe. If you're 25 and your net worth is 50 grand and you go to zero, like who cares? Like it doesn't matter. You know what I mean? Obviously it matters because you got to go make that 50 grand back. And obviously that's a scenario that you for sure want to avoid, but you need to be able to think about making decisions where that's not something that completely cripples you with fear. If you're 55 and you make a big bet and you lose your net worth, well, that is an incredibly terrible outcome that will completely ruin your life because you don't have the time to make it back because you're 10 years from retirement, if we're going to use 65 as a retirement age. If you're 25, you're a few years out of college, so long as you don't make it a decision that significantly impairs your ability to continue getting back up to the plate, such as you destroy your credit or such as you ruin your reputation with folks, around you, or to where you take on some type of risk that goes above and beyond just capital loss, but actually impairs your ability to secure lending, to work with partners, to do anything like that. That's different. That is, you need to be careful about that. But if we're just talking about losing dollars, then it's an entirely different situation, right? So this is literally my advice to the 25-year-olds who come to me and they're like, I bought a duplex, I'm a house hack, and I want to start doing more. I want to do more. I'm like, okay, like how much do you know about going direct to seller, finding hairy deals, putting together debt at slightly higher LTVs? Because that's really what you have to do if you want to achieve the goal that you're telling me that you'd like to achieve. I know you live in a really nice area. You're going to be comfortable buying like C-class buildings that are like pretty rough, that are occupied by residents that might not be paying rent. Like all of these things are things that you need to be comfortable with because that is the roadmap, right? When we think about the spectrum of how many investors grow their businesses and evolve over time, you're the 25-year-old taking on a lot of debt, a lot of risk, spreading yourself thin, probably doing, trading time for dollars, even within the real estate realm of your self-managing or your self-GCing, whatever, probably buying stuff in rougher areas. And then as time passes, and now we get up to like this 40-year-old investor, right? The second kind of, step in this 30-year career we'll talk about, which is, all right, you might be married, you probably got some kids, probably don't want to take on as much risk as you were 15 years back when like, the stakes weren't as high. Now the stakes are getting higher. You're probably a little less comfortable with debt or taking on a lot of debt rather. Instead of like buying deals with bridge and hard money or whatever, now you're purely going to use bank debt and stabilized debt. And maybe you only want to do deals at, max of 70, 75 LTV with plenty of debt service coverage, and you're not going to do a deal on the buy side unless you use a good loan when you buy. Good meaning something that's stabilized. You're okay with taking a little risk. You want to, maybe buy some moderate value add deals here and there, but you kind of want them to be in good areas, right? It should be in B class areas, maybe slightly more recent construction, 80s, 90s or newer, whatever it might be in your market. Still willing to take a little risk, right? You've got 20, 25 years of earning potential left in your career. But hey, you got, two kids that are under 10 years old, right? And you're like, there's still some risk here, right? In terms of you can't go to zero. That's not an option at 40, period. You can't lose money, right? Like this is something where you really need to protect your downside and you can't take the types of risks you did when you got into the business 15 years ago. Like that's the evolution here, right? That 40-year-old can give that 25-year-old some good advice, right? They can still put themselves in that position, but your motivations are changing. And as you continue growing as an investor, you probably start to trade out of those B class deals. Maybe you still had some C class ones that you're selling out of, and now you're going to start to exchange into like really stabilized, recently renovated buildings that don't demand a lot of your time, that don't, where you don't feel like you're taking on a significant amount of risk from a renovation standpoint, tenant based standpoint. This is oftentimes when investors start getting into other asset classes. Like, they sell their 20 unit B minus class building and they exchange it into a 5 storefront retail strip center on long term leases where it's purely passive. Like this is when a lot of those decisions are starting to be made. And the psychology of how these folks and these investors and business owners are making these decisions continues to significantly evolve. I'm in my early 30s, but like I've been in real estate for as long as a lot of the 40-year-old guys have, right? Just because I got into it at an early age and tried to really rapidly grow a business over the last 10 years. And I can feel myself getting to a stage of more capital preservation versus more aggressive growth. And it's a shift you feel innately, and I'm starting to feel that happen in my own business and a lot of my contemporaries and peers' business who are early mid 30s, moving to a new season of life, in some capacity here, married, some kids. They've been in it for 5, 10 years. They kind of feel things changing for them. And the lens of which you make decisions is totally different. And what I highly urge folks to do who are listening to this episode that are younger or newer in the business is to seek out advice from people who are one step ahead of you and not 5 steps. Like if you're 2 steps ahead of someone who's asking you advice, you can still put yourself in their shoes, which I think is the most important thing to do when you are providing advice to someone. It's really hard to do that if you're asking someone 5, 10 steps ahead of you. So if you're somebody who has 5 units, ask somebody who's got 50 or less doors, who's ideally in the same season of life or a similar season of life as well. If you're the 25-year-old with 5 units, don't ask the 50-year-old who's got, the 55-year-old guy who's got 50. Even if he's, paid them all off and is worth a billion, bajillion dollars, whatever it might be. Not a billion. It's probably hard to get that guy on the horn for advice. But a whole bunch of money, it's still going to be hard because they're not in the same season of life that you are. And that really does significantly impact their ability to give you advice that you can actually follow and use in your day to day. So, and actually, I got to mention this before we wrap too. It's critical to seek out advice for folks who are in a similar market as you. If you're an investor based in Ohio and Cleveland or Cincinnati, and you can buy multifamily at 80 grand a door, and you even if you've got 10, 15 units, and you're asking an investor who owns 40, 50 units, maybe they're only 5, 7 years older than you, similar season of life, but they invest in Boston, Massachusetts, where real estate sells for 300 a door, 400 a door, whatever it might be. Like there's probably just such a difference in approach to that marketplace in terms of, landlord tenant laws, renovation costs, the nuances of how to approach the building of a business. And even if, again, you could still, I'm sure, learn something from these types of people. And I certainly don't want to imply that there's nothing to learn from the folks who are in the different market or who are 10 steps ahead or 30 years older. That is by no means what I'm implying in this episode or implying. But what I really do want to imply is that consider context thoroughly when asking other folks for their 2 cents in your situation. You're much better if you're that guy who's got 10, 15 units in Cincinnati to ask the investor who's got 50, 60 in the same market. Like those are going to be the people who can really help you. And I'll give an example of what this looks like for me. We run, I should say I run, but we have a team, right? A multifamily real estate investment firm that goes out there and raises capital from investors to buy small to mid-sized multifamily deals throughout New Hampshire and parts of New England. I personally invest and buy deals myself. I do a handful of those deals every year, and the remainder we raise capital to buy. I'm also a partner in a property management company that manages 900 plus units in southern New Hampshire right now for other investors, and then a portion of that's our units. And we've roughly, the portfolio right now is right around 500 doors. When I'm going out and looking for advice from folks, I want to get advice from the guys who own or control, I should say, 1,000 units, who went from raising $5 million a year to raising, well, we're raising a little bit more than that, 5, 10, on some years. But I want to get advice from the guys who are raising 10 to $20 million a year. I want to seek out advice from the folks who went from doing a high volume of like small to mid-size, 10 to 50 unit deals to doing a handful of these bigger 50, 100 plus unit deals every year. Like those are the people that I want to learn from. I'm sure that I could learn from folks who are buying 1,000 units a year and who own or control 5,000 units in multiple different markets, but they're a little too far removed from my situation, and I'm not sure how contextual that advice is going to be. Additionally, I don't even really want to grow the same business that these people are running, and that's the whole other thing I forgot about is don't ask for people who haven't achieved or have the lifestyle design that you want. I don't necessarily want to run a business where we own and operate 5,000 units, where our team purely in the investment side of the business, not even talking about the property management side, which would be hundreds of people, but on the investor relations, acquisitions, admin, marketing, all of that side, at least a 10 plus person business at that size, probably more, probably 15 plus. That's not really a business I want to run right now. So that person, like, again, he could probably help me get to 1,000, I'm sure. But like, again, that advice is not going to be that contextual. And frankly, that's not even a person who I'm trying to emulate from a business growth standpoint anyways. So at the risk of rambling here and going a little long, I think that the big takeaway here is look for investors or business owners who are in a similar season of life as you are and who are one or two steps ahead from a business growth standpoint to provide you with advice. And understand that, my framework here is the 25, the 40, and the 55-year-old investor business owner are all going to give you very different pieces of advice because of contextually speaking, what season of life that they are all in. I hope this was helpful. I hope you guys learned something in this episode. I know this was a bit of an out of left field one, but hopefully this is something that you guys will consider as you continue to go out there and network with folks who might be able to assist you in the growth of your business. If you feel like you did learn something, please leave the podcast a rating and review. And thanks again for listening, and I'll catch you guys on the next episode.